Amit Sachdeva joins us. He's India Equity Strategist with HSBC. Let's connect with him and understand what their view is and what exactly are they indicating to their clients. Amit, good morning. Thank you for joining us. Amit, first let's understand what is your take on the geopolitical tensions which are happening in Israel. The way markets have been resilient, both local market and global markets, looks like markets are saying this is not Russia and Ukraine. I mean, this is very localized and it will unlikely to have a financial disruption.
I thank you so much, Nikunj, for having me here. Good morning to you all. I think, geopolitical situations are always interesting and also hard to predict, right? It's one thing can lead to another. So I'm not going to call that out, to be honest. But I think market obviously has taken a view that situation will be contained and would not spiral out of control, etc. So at least market has taken that view. My sense is that could probably be the fair view as well. But more importantly, India's context is very interesting because, India is coming from a place where we are outperforming region 3 years in a row. And that's what makes many people think that whether this rallies can continue. But I think we need to drill down into entire Goldilocks scenario of India. My sense is that two vulnerabilities for India. One is obviously geopolitical crisis. If it spiral out of control, then it might weigh on India's investment case. But also US bond yields have risen quite sharply, and that has seen some outflow as well. But if you look at the overall picture for India's Goldilocks, I would hazard a guess that based on the cycle work we have done for the last 20 years of market cycles, our view is that India is in a decisive bull run. And we are in the middle of it right now. So once, and I think it's fair to say that Indian market has that resilience that once the bull market or context sets in, it doesn't go away that easily. So any sort of event such as near-term some crisis or bond yields going up, it tends to sort of, have a short-term consolidation, which is very shallow, and then market goes up again. And the kind of evidence we are seeing today, this morning as well, is kind of that.
You're making a case that it's time to rotate out of mid-cap stocks and small-cap stocks into large-cap stocks. While there is merit based on valuation parameter, do you think flows and liquidity, in a sense, will be the restrictive factor because FIs are selling, they invest in large-cap stocks. HNIs are buying, they buy mid and small-cap stocks. Demat accounts are opening, by large cap stocks, they typically chase the momentum. So while there is a big, strong fundamental case for buying large caps and selling, buying large caps and selling mid caps, do you think in totality it may not play out?
No, it's a great question, and I think market will continue to sort of wager on that. So my sense is that look at where we are in the cycle. If you reflect all the bull runs of the past, you'll find that the mid caps tends to have a run of 1.4x the market run. And bull runs are, mid cap rallies are a symptom of those bull runs. And this market is no different. It is typical of that bull run. And we are decisively in a bull run. Now, that run is about 1.8x today, so which is slightly larger. So in some sense, small and mid caps are running ahead of the overall market by a wide margin. Now, it also leaves valuations of large caps relatively more tenable and reasonable. And hence that feeds into India's attractiveness. The domestic flows, which obviously are very resilient, and FI flows have become slightly negative. But we argue that FI flows, which has turned negative on events such as US bond yields, is a very short-term phenomenon. We are looking at, last year's flows about minus 17 billion. So we are sitting on a very low base of FI flows. In fact, if you go back 2021 and 22, we have seen about 34 billion outflow. So for FI flows point of view, we are actually in a very benign base. So some shortfall in FI outflow is not an indication of that it's a sustained sort of outflow that can happen. So that's point number one. My sense is that FI outflows are very short term and probably would rebound as we go along in the months, as the earnings shape up and other things. Mid cap rallies is just a bit of a caution. Two reasons. One, mid-cap breadth is about 93%. Now, 93% breadth, we've seen that it sort of doesn't sustain for very long time. So it's a bit of a worry that one need to put a caution into it. It is also true that for the entire spread of bull runs, mid-caps and small caps tend to outperform. right? It is not a case where they tend to sort of underperform as we approach the bull run end, etc. No, they continue to do well. But what happens is market learns from the past, and we see the evidence today that today incremental money is coming in the small cap and medium mid-cap scheme because that's what outperforms and everybody knows it. But it generates its own excesses. To avoid some amount of those excesses, one has to be very careful. We also see some good mid-cap ideas, but also we need to be careful that we don't overpay and buy the excessive momentum there. So element of caution built in is very prudent at this point. And that's what we want to say, that imminently some large cap become very appealing. And as FI flow returns, there could be rallies expected there as well. Because we are in a bull run and where large cap and mid cap both can perform very well. One has lagged behind, will catch up. One has overrun, may have take a breather some time, but then both have a potential to participate in the bull run.
That's quite interesting.
I hope that answers your question.
Yes, it does. And, brings up many more questions from what you just spoke about, Amit, as well. What would have to change on ground, or what are the cues that triggers that'll make FIIs come back to India equities? Because I was just looking at the data. This is one of the largest selling sprees that we have seen in the recent history, a consecutive 14 days of a sell-off from FIIs. What would have to change on ground for them to come back? And would it only be a function of the way the US yield pans out?
It's largely that factor, to be honest. See, if you look at FI flows, and if you have to put that in the context of bull runs, we are about 0.6% of the market cap. Last 12 month FI inflow. So every time you look at FI inflows, you have to look at accumulated flow of last 12 months, because you may see some incessant flows in the last 6 months, assuming that is the massive inflow that's already come. But it's true because the base is very, very benign. So we are at about 0.6% of market cap, which is way below the bull run averages at 1.7 and perhaps 3% of bull run peak. So in some sense, the flow, the base is extremely benign. We've seen large outflows last year, to be honest, minus 17 billion to be precise. So we are sitting in we've just seen few months of inflows, and that has turned negative, and that to minus 2 billion in August and September, and some negative in October as we beginning. But it's largely driven by uncertainties around global events, but also US bond yield rising, and there's a snap reaction on India as well. If, for example, but that has a short-lived reaction. So if earnings in India are holding up, we're not seeing any major downgrades. Crude, which was a worry for me, to be honest, when it was touching 95, it was going 100. I was worrying that that might weigh, but that has gone back to 83, 84. So in some sense, crude is still behaving in a normal zone. As Nikunj rightly points out, the long-term trajectory for crude is downwards, not upwards. So it is not a fear. Even inflation in India tends to be sort of moving downwards, and RBI's view would be also that it is tameable, and looking at 5% and next year 4.3 even for next year 1 year view. So in some sense, inflation is not a worry as well. So I think India's Goldilocks scenario, which is built up of earnings, stable macro, stable inflation, to FI flows, valuation, breadth, everything put together, a large part of Goldilocks is positive. Some externality are negative, which gets priced in a short phases like that. So I would probably think that if earnings are delivered and not major downgrade cuts are happening, we have a case that it's a case for rebound. We should not also forget that while India may have outperformed in 3 years in a row, but 22 was a negative year of performance. We were down minus 10 approximately. And in 22, we have performed, but we are just up 9% on a full year basis. It's just a March rally. So valuation is also okay. So I don't see any reason, given the stable growth macro and where the world is today, India continues to be a very attractive destination for FIs. And that is not going to go away with 1 month of small short-term volatility or event. I think the larger game is set. If you look at the longer picture, what gives you a confidence that India should do well? Look at last 20 years. We have 14% CAGR, but only 4 times in probably 20 years, India has delivered negative returns in local currency. It's seen as a more structural market. But another factor that has worked in India's favor is that when you survive crisis, the resilience is proven. For example, we've seen 2 successive crises, like COVID crisis, India stood out. Another test of India was how it will behave when Ukraine war has happened, what is grappling with recession fears and inflation. Look at India. Another point was proven that India has far more resilient than it was ever in the past. That also has led to, I would say, India's flow being more structural than tactical and cyclical. I hope that answers, but it's again anybody's guess. I feel that the structural appeal of India is on a massive rise.
Oh, you're right. And you've given those compelling examples as well to support it. I'd also, Morning, firstly like to get in your views when it comes to individual sectors and in particular the opportunity within the pharma space. No doubt we have already seen that run play out. So my question is, do you think that even right now it's a compelling opportunity to look at pharma, or do you think that it's perhaps to a certain extent run its course?
In a sectoral framework, what we have put together in the last published report, which breaks sectors down into sort of two dimensions, how optimistic you are and how business dynamics are. So pharma I would put it in a bracket where business dynamics are also turning positive, but investors have also started to run a little bit positive. But it's still in a very favorable zone that given the underperformance of the past, pharma is still very favorable. So we continue to like that sector in a sectoral framework. Another sector which stands out for us is financials, which has some opportunities which could be very compelling as well. If we were to look at broader framework, but if we were to believe that market would turn risk on, which means that bull runs will continue and sector rotation will continue, we continue to see IT has an candidate for re-rating as well, even though the growth obviously in the near term is challenged, but incremental positive news can also benefit the sector. We see positive momentum for autos as well. We see positive momentum for consumer discretionaries too. So in some sense, those sectors tend to look favorable in our view. We are slightly cautious on consumer staples there because that sits unfavorably in our framework where dynamics are turning a bit negative, or at least investor already discount a lot of these expectations of near-term margins and growth, etc. So maybe that area we are a bit cautious there.
All right. Really appreciate your time, Amit. So glad you could join us and certainly hope to see much more of you going forward.
Thank you, Nikunj. Thank you for having me here. I hope this helps.
Thank you very much. Indeed, it was quite helpful. And I'm sure our viewers will take note of that why there is a strong appeal when it comes to the macro positioning of India.